What up, Hyperchange? Welcome to another episode. We're mixing it up a little today, not talking about Tesla or Amazon or any company you've probably heard of. We're talking about IPG Photonics, a fiber optic laser company based in Massachusetts. This is a company and a stock I've been following for years, and I think now is a really interesting time to make an episode. So a little bit of history. Almost exactly a year ago, I put out my first Hyperchange video on IPG when the stock was almost exactly at the same share price today, around $166 per share. In the past year, though, the stock has rocketed, as you can see, from that 166 level all the way above 250, and has since come back down right to the level where it was a year ago. So that'll be a perfect time to update my thoughts on the company and why I'm so excited about the potential of IPG. But before we get into it, I want to play this quick corporate video from their YouTube channel just to give you a little bit more flavor about what the company does.
Greatest productivity and unique reliability, compactness and versatility, working on a wide range of materials and easy to use and integrate, drastic reduction in energy consumption and reduced running and maintenance costs. The fiber laser is all this. There's no question anymore about what laser is most in demand in the market. It was clear long ago to many leaders in various industries, and they have made their choice. Time puts everything in its proper place, and quite fast. Much faster than anyone could imagine several years ago. A new era has begun, the era of industrial fiber lasers.
So as you can see, IPG's fiber optic lasers have a ton of different industrial manufacturing use cases. One of which that caught my eye particularly in that video was this little clip where it looks like robots are welding together some sort of car, eerily similar to what happens at the Tesla factory. So I'm always at the back of my mind wondering if Tesla is indeed somehow leveraging IPG's fiber optic lasers in their manufacturing process, but that's a tidbit we'll get back to later. What's so interesting about IPG is they are a vertically integrated company. So they have invented and pioneered this fiber optic laser technology. They have hundreds and hundreds of patents, years of R&D that have gone into this. This slide from their most recent investor deck does a great job of showing sort of the scale of their vertical integration. You know, they're constantly ramping the amount of proprietary chips that they're selling. The cost per watt decrease of those chips is very consistent. You know, I sort of think of this as almost like a parallel to what Tesla's doing with batteries, where they are producing the most of them and they're constantly reducing the price, and that sort of price reduction is the backbone of their industry-leading margins and disruption. And as the price of their chips and the cost of these fiber optic lasers continues to decrease, the amount of industries that they can disrupt and the use cases continues to expand. But what gets me really excited about IPGP, because personally, you know, I'm not a fiber optic laser expert, I'm not an advanced, you know, additive manufacturing expert, is the company's financials. As you can see, IPGP has just an unbelievable track record of growing revenue and earnings. Since 2004, the company has produced a revenue CAGR of 27%. You know, this is an incredible compounding story. Now, earnings have grown even faster than that. 49% CAGR for operating income since 2004. That's a little bit of a misleading stat because they had such strong growth in 2005. So if we take that out, even still, that 36% operating income CAGR just goes to show you that this is a monster. You know, I used to call them the fiber optic laser juggernaut, and I really think that's an appropriate title because they have invented this technology, they've pioneered it into the market, and they have shown tremendous financial success in doing so. And as you can see, you know, their operating income has grown faster than revenue because their operating margins continue to expand. I mean, IPGP has consistently produced operating margins of, you know, above 30%. That means for every dollar in revenue they bring in, over 30 cents is profit. This is up there with the most profitable companies, software players in the world. And the one little blip you're seeing there on the chart is from the Great Recession, and even still then, they were still able to produce a solid profit margin of 5%. But if we compare this to companies like Facebook, Apple, Google, you'll see that IPGP is up there with the best of them in terms of operating structure and profitability. So this is just a phenomenal business. I mean, it's very rare that you see a chip maker or a hardware maker be able to sustain margins at this level, you know, for such a long period of time is incredibly rare. And that's one of the reasons why I believe so strongly in the leadership of IPG's technology, because they're showing tremendous pricing power in the market and the ability to command a massive premium, and therefore that is why they have these margins. And they're so profitable. The company has barely any debt, and you can see their cash pile is just soaring. They have over $1.1 billion in cash on their balance sheet as of the end of 2017. If we take a look at what I'm expecting for 2018, you can see that growth is actually slowing to about 8% per year. 2017, they grew revenue by almost 40%, operating income at similar levels, just absolutely monster growth, and they're continuing to grow on top of that this year. Just for reference, that 8% revenue growth number is right at the midpoint of management's guidance of 7 to 9% revenue growth. So if we take a look at IPGP's valuation based on my expected 2018 financials, looking at a $9.1 billion market cap with 55 million shares outstanding, 9.1 billion divided by my expectation for about 1.5 billion in revenue, looking at 6 times price sales. 9.1 billion divided by 595 million equals only a 15.3 times price earnings ratio. So IPGP, this incredibly industry-leading, hyper-profitable fiber optic laser company, is trading at a cheaper multiple than the entire stock market. This is what gets me excited. And what gets me even more excited is, once again, that booming cash pile that I just mentioned, we can put that to good use. As you can see, IPGP's share count has expanded consistently throughout the past 13 years, and although this is fine, my pitch is the company should start leveraging their massive cash balance to start buying back a ton of stock, especially at these depressed prices. And they did authorize about 125 million share buyback in their most recent quarterly report, but that is just to mitigate the dilution of employee stock options, not actively reduce the share count. I think IPGP should put like $500, $600, $700 million into a share buyback program and meaningfully reduce the share count at these levels because the stock is so cheap. So take a look at this extrapolation I made where I projected if IPGP starts buying back its shares, they could start decreasing their overall share count. They could spend less than $500 million over 3 years and meaningfully reduce the share count, which would really increase the long-term, upside of a potential investment today. Now let's play this out a little bit further. Let's assume they do the buyback, and now let's extrapolate some 2019 financials. So I'm expecting that growth will sort of rebound back to 10% in 2019. Actually, this is a super lowball estimate, but I wanted to be conservative. I assume that margins stay flat. They grow earnings about 10% in 2019 as well, plugging in those financials, but also assuming that IPGP's bought back 2 million shares, so now we have a 53 million shares outstanding number. We get to about just an 8.75 billion market cap divided by my 2019 sales of 1.7 billion, looking at 5.2 times price sales, 8.75 billion divided by my estimate of 655 million in 2019 EBIT, and we're looking at 13.4 times price EBIT on 2019 if they buy back 2 million shares. And 2 million shares at today's price of 165 is just over a little over $3 billion or $300 million. If IPGP puts, $700 million into their share buyback, they could potentially reduce the share count by 4 million shares or like 8 or 9%. So I think there's a ton of exciting potential here if IPGP starts to buy back its stock. And that's one of the main reasons I wanted to make this video is I think IPGP management, if you're watching or listening or you're a shareholder, I think you should really be pushing for them to be buying back stock, especially at these levels. Now, you might be wondering, why is IPGP so cheap? Why is the company with a track record of compounding revenue at 27%, compounding earnings at 30+% for over a decade, is trading at below a market multiple when it still seems like they have massive potential to grow their core business? I think one of the biggest reasons is very, very weak guidance. IPGP, in this slide in their latest investor deck, shows that, they're expecting long-term their revenue growth to just be market growth, which indicates just a couple percentage points of revenue growth in the long term. That's a huge low ball and would be a massive slowdown. And I don't understand, rationally why that would happen, but more on that in a second. Additionally, gross margin, which was 57% in 2017, they're expecting long-term to just be 50 to 55%. Additionally, that operating margin of 39% in 2017, they think will go to 32 to 37% in the long term. So what they're saying with this guidance slide is we were as profitable as we're ever going to be in 2017, and growth is about to slow down dramatically. So that's why the market is assigning a cheap multiple to this company. But I'm thinking this is just totally wrong guidance. They're totally sandbagging this. It makes no sense why IPGP will get less profitable as time goes on, in my opinion. Think about it. They are the leader in vertically integrated fiber optic lasers. The cheaper these lasers become, the more industries they're going to disrupt, and therefore the more incremental sales and revenue that IPGP is going to get. I see no reason for their cost structure to continue to bloat and decrease margins. If anything, as they expand and their fixed costs stay steady, they should be increasing both gross and operating margins. So unless there's something I'm missing here, and if I were to get on the IPGP conference call, this would be the question I ask. why are you expecting margin contraction when we're still so bullish in the overall core business's story? Moving on to the risks for the company, because I think this is really important for IPGP. They're trading at a cheap multiple. It looks like they're super profitable, a ton of cash. What could go wrong? What are the issues here in my thesis? I think one of the biggest things and problems of my understanding of IPGP is simply I've never bought a fiber optic laser. I've never seen a fiber optic laser that I know of. I don't know, how much better their products are than the competition really. So I just don't have industry expertise. When I think of Tesla or Amazon, I'm a potential customer of those companies either today or in the future. And that gives me key insight in understanding, their market positioning from a consumer's perspective. I'm not a consumer of fiber optic lasers. And so I think that gives me a huge sort of hurdle to overcome when analyzing IPGP. So I'm just not an expert in this company at all. The other big risk that I think needs to be addressed is that Valentin Gapontsev, the pioneer who invented this company, is very, very old. I think he's above 70. Management of the company is very, very old. So I like to see, if I'm investing in something for the long term, you want to see some youth coming up in the organization, or at least a game plan for some sort of succession strategy. But we haven't really seen that for IPGP. So what is their end game? Would they sell out to a massive company like Berkshire Hathaway? I mean, this seems like exactly the kind of company Berkshire would love to buy. Cheap multiple, vertically integrated, top-notch management, super profitable, bulletproof balance sheet. So that sort of sums up my thoughts on IPGP. Fiber optic laser company. In the long term, I think they're going to continue to grow revenue and earnings at a very healthy clip, yet they are trading at a multiple well below the stock market. So I think there's a tremendous amount of upside for IPGP in the long term. If management launches a share buyback, I think that upside could get significantly compounded. So I just think this is a really high quality business, something that's super behind the scenes. You don't think of fiber optic lasers that much in everyday life, but they are a backbone of these super advanced manufacturing techniques that are getting more and more relevant and more disruptive by the day. So I'd love to know any comments and insight that you have about IPG Photonics, about fiber optic lasers. This isn't my wheelhouse, so if you're an expert, please leave it in the comments below. Additionally, I wanted to quickly shout out a comment, because on the last IPGP video, I got a comment from someone who worked at IPGP, and I'm going to quote something that he wrote in his comment. Also, another reason why we are extremely efficient is because any excess heat we produce from testing our lasers in-house gets converted back into energy for the company through a process called cogeneration. This also drastically reduces our carbon footprint, making us a very green company. So I don't have too much insight into that, but I thought that was a really cool tidbit about how they're leveraging their excess energy to make their system more sustainable. Really cool stuff. Anyway, this is Hyperchange. If you like the show, definitely check out our Patreon page and consider supporting there. Anyway, I'll see you guys next time.